Hey everyone, it's Alex Morgan here. Silver is under pressure again today. The price action is weak, momentum is negative, and traders are asking a serious question. Is this just short-term volatility, or is a bigger drop coming? If you're holding silver, thinking about buying the dip, or trading short-term moves, you need to understand what's happening beneath the surface. Because this isn't just about one red candle. It's about the broader macro environment, positioning shifts, and how capital is moving right now. Let's start with what we're seeing today. Silver has been struggling to hold key technical levels. Recent price action shows lower highs and lower lows. That tells us sellers are still in control in the short term. Every rally attempt has been capped quickly. Buyers step in, but they don't follow through with enough force to shift structure. When markets fail to reclaim previous support after breaking below it, that's a warning. It means confidence hasn't returned yet. Now let's look at the macro pressure points again, but deeper. Real interest rates remain one of the biggest drivers. When inflation-adjusted yields stay elevated, silver faces competition from bonds. Investors ask themselves a simple question: why hold a non-yielding metal when I can earn a real return in fixed income with less volatility? That opportunity cost matters. Even if inflation isn't collapsing, as long as real yields remain positive and stable, silver doesn't get the same urgency bid it receives during aggressive easing cycles. Then there's the dollar. A firm dollar doesn't just pressure commodities mechanically, it signals global capital preference. When global investors prefer dollar assets, liquidity concentrates in the US system. That tends to pull capital away from metals in the short term. Silver thrives when the dollar weakens. It struggles when the dollar holds strength. Industrial demand adds another layer. Silver's role in solar panels, EVs, electronics, and advanced manufacturing gives it structural demand support. But structural demand does not prevent cyclical corrections. If investors believe global growth is slowing, they discount future industrial consumption. That's exactly what happens during uncertain economic transitions. And right now, we're in transition. Inflation is cooling but not gone. Growth is slowing but not collapsing. Central banks are cautious but not aggressively easing. That in-between environment creates hesitation, and hesitation creates volatility. Let's talk about positioning in more detail. When leveraged funds reduce long exposure, it doesn't just affect price, it affects confidence. Once price breaks key support, systematic traders often add short positions. That adds downward pressure even if fundamentals haven't dramatically changed. At the same time, retail sentiment often becomes split. Some see opportunity, others panic. When sentiment is divided, markets remain unstable. Now let's zoom out even further. Historically, silver has been one of the most volatile major commodities. It amplifies macro moves. When liquidity expands and inflation expectations rise, silver often outperforms gold. But during tightening cycles or growth scares, silver underperforms gold. If you compare silver's behavior in past tightening environments, you'll notice something important. Bottoms rarely form in a straight line. They form after extended consolidation or sharp capitulation. We haven't clearly seen capitulation yet. Capitulation typically involves extreme volume, emotional headlines, and widespread fear. We're seeing pressure, but not panic. That means downside risk cannot be ruled out. Now, what could trigger a larger drop? If upcoming inflation data comes in weaker, and markets interpret that as justification for maintaining restrictive policy longer, real yields could rise. That would pressure silver further. If the dollar breaks higher technically, that adds another headwind. If equity markets experience volatility and investors reduce overall risk exposure, silver could temporarily fall alongside risk assets. But what could stop the drop? If inflation surprises to the upside, markets may price in renewed currency debasement risk. That often benefits precious metals. If central banks hint at earlier easing due to growth concerns, real yields could fall. That would remove a key pressure point. If industrial data stabilizes and forward guidance improves, silver's industrial identity regains support. So the direction silver moves next depends heavily on data. That's why reacting emotionally to one day's move is dangerous. Let's also address long-term structural forces. Global debt levels remain elevated. Governments continue running deficits. Over time, that creates currency pressure. Precious metals historically perform well in high debt environments, but over time is the key phrase. Short-term price movements are driven by liquidity and rate expectations. Long-term thesis plays out slowly. If you are accumulating silver for structural reasons, you need to accept volatility. If you are trading silver, you need to respect momentum. Momentum right now remains fragile. Another layer to consider is market psychology around previous highs. Many investors remember recent peaks. When price drops significantly from those highs, it feels like a discount. But markets don't revert simply because something feels cheaper. Price can overshoot fair value in both directions. That's why confirmation matters. Confirmation would look like silver stabilizing, forming higher lows, reclaiming broken support levels, and seeing volume increase on up days rather than down days. Without that, rallies may simply be relief bounces. Relief bounces can be sharp. Silver is known for quick rebounds, but if they fail quickly, they trap buyers. So if you're thinking about entering, consider scaling rather than going all in. Consider waiting for structure improvement rather than trying to predict the exact bottom. Patience is uncomfortable, but it protects capital. Let's also consider external shocks. Geopolitical tensions can instantly change sentiment. Supply disruptions can alter industrial projections. Unexpected monetary announcements can reprice the entire precious metals complex overnight. Silver is sensitive to narrative shifts. That's why flexibility is important. You don't marry a short-term view. You adapt as data evolves. So, is a bigger drop coming? It's possible. The technical structure remains vulnerable. Macro headwinds haven't clearly reversed. Liquidity hasn't decisively expanded. But it's not inevitable. Markets are conditional, not predetermined. Over the next few weeks, the key will be whether silver can defend current support zones. If those fail, technical traders will likely target deeper levels. If those hold, and we begin to see stabilization, that opens the door for base formation. Base formation is boring. It doesn't generate headlines, but it's often the foundation for sustainable rallies. Right now, we are in the evaluation phase. The market is testing conviction. If you're long silver, manage risk responsibly. If you're waiting, watch confirmation signals. If you're short-term trading, respect volatility. Silver remains an important asset in the global system. It has monetary relevance. It has industrial necessity. But price direction in the near term depends on rates, liquidity, and positioning. Those are the drivers. Don't let noise override data. Don't let fear override discipline. And don't let hope replace confirmation. We'll continue monitoring real yields, dollar momentum, industrial data, ETF flows, and futures positioning, because that's where the real story is. If you found this extended breakdown helpful, make sure you hit the like button. It helps the channel reach more serious investors. Subscribe for ongoing silver market analysis and precious metals updates, and stay tuned as we track whether this pressure turns into a deeper correction or the setup for the next major move. I'm Alex Morgan, and I'll see you in the next video.